That is what we know at this point. Of course, this was a highly anticipated decision. Despite the events of yesterday, the confusion around whether or not approval had happened at that point, it turned out it did not. But it is indeed happening now. These spot Bitcoin products for the first time in ETF form being approved here in the U.S. All 11 of them remain.
Traders looking for a simple way to invest in Bitcoin got their wish when the Securities and Exchange Commission approved several exchange-traded funds that invested directly in the cryptocurrency last January 2024. Before investing, you might need to know what this new update is about. Will it be profitable or the other way? The decision to approve the funds was largely expected after an earlier court ruling questioned why the SEC treated Bitcoin ETFs differently from similar products. After this probe, the Securities and Exchange Commission regulated all ETFs traded on U.S. exchanges. In August 2023, an appeals court ruled against the SEC for rejecting an application from cryptocurrency asset manager Grayscale Investments to list its spot Bitcoin ETF on the New York Stock Exchange. The court ruled that the SEC was arbitrary and capricious in rejecting Grayscale's application since its proposed Bitcoin ETF is materially similar to already approved Bitcoin futures ETFs. The agency gave the green light to sponsors of 10 ETFs, including BlackRock, Invesco, Fidelity, Grayscale, and Ark Invest, paving the way for these funds to begin trading as soon as this week. What is an ETF?
So an ETF, or exchange-traded fund, is really quite simple. Think of it as a basket of goods. You can buy a share of that basket to have partial ownership of the contents of the basket. Those shares that you then own can be freely traded on an open exchange.
An exchange-traded fund is an investment fund that holds assets and issues securities as fund shares, which trade on an exchange. ETFs are traded on stock exchanges, providing investors with diversified exposure to various asset classes and the flexibility to buy or sell shares throughout the trading day at market prices. Instead of holding many different stocks, an investor can simply own shares of one ETF invested in those companies. Exchange-traded funds are similar to mutual funds, but can be traded on an exchange like stocks. ETFs track the performance of their assets, which might include a diversified basket of securities like stocks or bonds, or even single commodities like gold, silver, and crypto. Bitcoin ETF. Not all Bitcoin ETFs are created the same. Depending on the ETF type, investors could purchase very different products. The two main types of Bitcoin ETFs are Bitcoin futures ETFs and spot Bitcoin ETFs. Until January 2024, the U.S. market primarily offered Bitcoin futures ETFs. These ETFs invest in futures contracts, which are agreements to buy or sell Bitcoin at a future date at a predetermined price. While they aim to track the price of Bitcoin, they do not provide direct exposure to the actual Bitcoin asset. Futures ETFs often involve higher fees and greater volatility compared to spot ETFs. They are typically more suitable for sophisticated investors who understand the complexities of futures contracts, including the need for continuous rollover. This rollover process can incur additional costs, known as rollover fees, passed on to the ETF shareholders. In contrast, spot Bitcoin ETFs, approved by the SEC in January 2024, offer direct exposure to Bitcoin. These ETFs hold actual Bitcoin, and their shares represent operational ownership of these coins. Managed by trusted custodians, spot ETFs aim to reflect the real-time value of Bitcoin, offering a more straightforward investment option for those seeking direct exposure to the cryptocurrency's price movements. In some cases, spot ETFs may even allow shareholders the option to redeem their shares for the underlying Bitcoin. However, this is subject to the specific ETF's policies and market conditions. Investors should carefully consider these distinctions when choosing between futures and spot Bitcoin ETFs. While futures ETFs might appeal to those with a deeper understanding of derivative markets and a higher risk appetite, Spot ETFs could be more aligned with investors seeking a more direct and potentially less complex investment in Bitcoin. As with any investment, weighing the specific characteristics and risks of each ETF type against one's investment strategy and risk tolerance is essential. Understanding Bitcoin futures ETFs better.
What are futures? Well, they are just another type of a financial instrument, and simply put, they are an agreement to buy or sell an asset at a set price on a set date in the future.
A futures contract is a standardized contract where two parties agree to exchange a specific quantity of a standardized asset on a specific day for a particular price. Bitcoin futures contracts are traded on the Chicago Mercantile Exchange. So a Bitcoin futures ETF is an exchange-traded fund that holds Bitcoin futures contracts and sells shares of the fund to investors. These shares are bought and sold on a mainstream exchange. These ETFs are created by purchasing futures contracts from the Chicago Mercantile Exchange Group and bundling them into a fund. Next, the company offers shares of the fund to investors. The futures contracts in the fund are then actively managed while the shares are trading. So, instead of trading Bitcoin on a cryptocurrency exchange, investors can trade these shares on a traditional exchange and gain exposure. Bitcoin futures ETF history. The first concept for an ETF that held Bitcoin emerged shortly after investors and brokers noticed that Bitcoin prices were trending upward and gaining popularity amongst investors. This signaled an opportunity to generate returns by trading Bitcoin. As Bitcoin's price rose to tens of thousands of dollars, retail and average investors lost the opportunity to invest directly in Bitcoin. In response to demand for investor access to Bitcoin, brokerages began to design Bitcoin exchange-traded funds. Applications with the Securities and Exchange Commission for approvals started in 2013 with the Winklevoss brothers. The first official Bitcoin-linked ETF was the ProShares Bitcoin Strategy ETF, which mainly uses futures contracts. It was approved by the SEC in October 2021 and is listed on the New York Stock Exchange. In many crypto fans' minds, a Bitcoin ETF would consist of Bitcoin purchased by a company, which would securitize it and offer shares to investors. However, the Securities and Exchange Commission rejected these proposals until January 2024. A court order in August 2023 forced the SEC to reconsider these proposals, and on January 10, 2023, the Commission approved 11 Bitcoin spot ETFs that hold Bitcoin. Goals of Bitcoin futures ETFs. Bitcoin futures ETFs are designed to allow more people to invest in Bitcoin without the necessary expenses and hassles of buying them directly. Some of these hassles are: 1. Security. While you don't technically have cryptocurrency in your wallet, you have security keys that you need to safeguard if you own Bitcoin. If you buy your cryptocurrency through an exchange, you can choose to have your keys stored on that exchange if it offers that service. However, wallets and exchanges can be hacked and keys stolen, which means your cryptocurrency can be stolen. You can store your keys offline using several methods, but none are 100% secure or guaranteed. An ETF doesn't require you to own any cryptocurrency, store keys safely, or move the keys back and forth between different types of storage. You own shares of the fund, which doesn't own any cryptocurrency, either if it's a futures fund. 2. High prices. One of the most significant obstacles for average investors is price. Bitcoin set a record high of nearly $69,000 per BTC shortly after the ProShares Bitcoin Futures ETF was listed on the NYSE. Over the next few years, its price dropped to under $17,000, then rose to between $20,000 and $30,000. Since late 2022, the price has slowly risen, floating around $30,000 for a period and around $41,000 as of January 2024. The high price means that even at today's medium prices, retail investors may not have the assets to purchase one BTC. While you can buy smaller Bitcoin denominations on cryptocurrency exchanges, an ETF allows you to gain exposure to BTC within your budget, risk tolerance, and investing goals on a fully regulated exchange using an approved instrument. Before I move on to the benefits of ETFs, what do you know about Bitcoin ETFs? Share it in the comments section below. Benefits of investing in Bitcoin ETFs. A Bitcoin ETF provides a simple, easy way for institutional and retail investors to invest in Bitcoin. However, institutional investors and other large investors, like family offices, have no clear way to invest in Bitcoin while complying with regulatory standards. For the average individual, buying and holding Bitcoin requires research and technical knowledge. Signing up for an exchange account, maintaining a self-custody wallet, and learning how to manage their portfolio are responsibilities that some may not want to take on. A Bitcoin ETF could be an easy fix to these hurdles. Being responsible for the security of one's coins becomes irrelevant. Investors can simply buy and hold shares in their brokerage or retirement accounts. Regulatory concerns also vanish. The SEC must approve the product to be listed on an exchange like the NYSE. Trading such a security can be done with ease. So, investing in a Bitcoin ETF could be a good option for people looking for a more traditional way of investing in the digital currency. Investing directly in Bitcoin can be complicated and involves questions about how the asset will be stored and which exchange to purchase. ETFs removes some of that complexity by packaging Bitcoin into ETF form. The ETF structure could also make it easier for some institutional investors to enter the crypto market, which could help keep demand for Bitcoin high. While this can give a huge profit possibility, there are risks to be wary of. Risks and things to consider when it comes to crypto ETFs. Investing in Bitcoin ETFs, whether spot or futures-based, involves exposure to the underlying cryptocurrency's inherent volatility. This volatility can lead to significant price fluctuations, a crucial factor for investors to consider. While these ETFs provide a more accessible route to investing in Bitcoin, they do not shield investors from the market's high volatility. Unlike direct Bitcoin ownership, spot Bitcoin ETFs hold actual Bitcoin, aiming to track its market price closely. However, investors should be aware of the potential tracking error. This error arises when the ETF's share price does not perfectly mirror the price movements of Bitcoin due to factors like fund expenses and the timing of trades. This discrepancy can affect the investment's performance relative to holding Bitcoin directly. Regulatory uncertainty is another significant consideration. The cryptocurrency market is still evolving, and regulation changes can impact the Bitcoin ETF's legality, trading, and valuation. For instance, future regulatory developments could influence the operational aspects of these ETFs, such as custody and compliance requirements, potentially affecting their performance and accessibility. Experts warning. This is why some experts and organizations detest this crypto technology. Even some of these experts were against crypto from the start. For instance, legendary investor Jack Bogle famously warned people in 2017 to avoid Bitcoin like plague.
And someone said, "What did I think of Bitcoin?" And I answered with my usual tact, "Avoid it like the plague." And so how good was that advice? Well, and I also added, and don't tell me I'm wrong when it gets to 20,000. I'll tell you what it's worth when it gets to $1. Might as well be extreme.
More than 6 years later, Vanguard Group Incorporated is still stoking the crypto world's ire by sticking to the conservative investing approach of its late founder. Amid the euphoria unleashed by the long-awaited debut of the first fully fledged Bitcoin exchange-traded funds in the U.S., Vanguard sparked uproar with its pointed decision to refuse to offer the new ETFs on its gigantic trading platform. #BoycottVanguard started trending on X, accumulating thousands of posts, with users pledging to pull their money from the asset management giant. Vanguard's rejection of crypto stands in stark contrast to its industry peers. BlackRock Incorporated, Fidelity, and Invesco Limited launched their spot Bitcoin ETFs, while centuries-old State Street provides fund servicing to several products. U.S. Securities and Exchange Commission Chair Gary Gensler also issued a warning to investors looking to buy into crypto a day ahead of an expected move by the agency to decide whether or not to greenlight spot Bitcoin exchange-traded funds. In his ex-post, he advised you to be cautious if considering an investment involving crypto assets. Years before he would even make this statement, two of the most iconic investors we have on this earth, Warren Buffett and Charlie Munger, expressed their disagreement on crypto during the 2021 shareholder event. Munger vehemently expressed his disdain for Bitcoin, deeming its success detestable. The legendary investor doesn't welcome a currency that's so useful to kidnappers and extortionists.
Stop to think about it. It's an ideal currency if you want to commit extortion or kidnapping or have a protection racket or something.
The profit from Bitcoin ETFs is massive, as is the risk with a very short trading history and no underlying cash flow to support its value. Now that you know the gains and the risks, do you have what it takes to forge on? Let me know your opinion in the comment below. If you found this video insightful, remember to like and subscribe for more financial updates. See you in the next one.